Good afternoon, everybody, and welcome to our session on solar panel lending. Matt Young and I from the firm Weltman, Weinberg & Reis would like to welcome you to today's session. And I also want to welcome our special guest, Matt Myers. Matt is President and CEO of Goal Solutions. Matt leads a vertically integrated services business that manages over $42 billion in unsecured and secured loans. Goal partners with over 200 clients spanning banks, insurance companies, asset managers, investment banks, credit unions, and other financial stakeholders, provides services across multiple asset classes. Prior to joining Goal in early 2007, Matt worked at GE Capital in credit risk and statistical modeling for 6 years. Welcome, Matt, and thank you for joining the session today.
Thanks, Al. Great to be here. So I'll get the ball rolling. For those of you who know me, you know I can talk a lot, and Weltman has been generous enough to give me the opportunity to do so. But you know, at the end of the day, you know, we take this time out to share with you things that we hope you find valuable. So to the extent there are things that you want us to touch on, please feel free, drop them in the chat. I'll keep my eye on the chat and do my best to answer the questions. I'm gonna spend the first part of this panel talking a little bit about, from a lending perspective, you know, why we and our clients find the residential solar industry to be a really appealing asset class. You know, whenever we look at asset classes to partner with clients, and you know, we first start with what are kind of the macroeconomic factors around an asset class. We don't want to operate in an asset class that, you know, maybe is going to be short-lived, or one that we don't think is necessarily that large. And when you look at the dynamics of energy in the United States, you notice that utility prices are constantly rising. There's instability on the energy grid. There's typically more supply than there is demand. And if you look at recent dynamics around data centers, which are large consumers of energy, it's really exacerbated some of the strain on the current energy system we have in the country. There are alternatives. You'll hear a lot about things like nuclear and coal. Nuclear in particular, while I think really interesting, has a very long time to introduction. It'll take 8 to 10 years to build a nuclear power plant. And so while that could be a really interesting solution for a 5, 10, 15-year time horizon, it doesn't necessarily scratch an itch in the current state. When you look at residential solar is a product that on the rooftop side can be installed in 6 to 9 months. For individual homeowners, it can provide immediate relief. I live in San Diego, so in Southern California, you know, we're constantly dealing with energy issues related to, you know, elevated utility prices and occasional instability with the grid. The office I'm sitting in was blacked out for 5 days a couple years ago because somebody just happened to hit the wrong button in a breaker somewhere. So being able to de-risk yourself from the current grid and make an investment in saving money on energy over the long run is something that, you know, we see as a real value for customers. And so spending time around financing those systems is an area that we find is really interesting. When you look at the dynamics of lending in a space, one thing that we think is really unique about residential solar is it's one of the few lending products out there that generates a positive ROI. If you think about things like, you know, credit card or personal loans that are for credit card refinance, or private education loans or other products like that, if you're a consumer and you stop paying those loans, you just have more money. You have to deal with the consequences of adverse credit reporting and all the stuff that goes with kind of standard debt non-repayment. But at the end of the day, if you're solving for budgetary constraints, and one of the ways you want to solve for that is by not paying bills, not paying to a lot of your traditional unsecured installment obligations will get you a little bit more money, at least in the short term. With residential solar, there's a substitution effect. To the extent that you stop paying your residential solar, there's a high probability the system will get shut off. If the system gets shut off, you go back on to pulling from the grid again. And typically what you find with customers is that they're paying more for their utility bill than they were paying for residential solar. So, you know, while stop paying your solar bill might be something that, you know, today has a benefit for 15, 30 days, ultimately that utility bill is going to get turned back on. And so it's one of the things that, you know, we as a provider in the space partnering with our clients think is just a very unique thing. And so when we see lenders looking at, you know, where do we allocate balance sheet to? Should we allocate it to, you know, kind of more traditional traditional unsecured installment assets or something like residential solar, what we found is that there's just better performance because of the substitution effect. If you look at the type of customers who are typically drawn into residential solar, they tend to be pretty high credit quality. You're talking about homeowners with generally high FICO scores. They have a demonstrated ability to manage obligations. If you look at your kind of standard residential solar portfolio, it typically has an average FICO score right around 745 or 750. It tends to be very low volatility from a performance perspective. So while it's not a zero loss product, and at the end of the day, it's not a mortgage, it is a product that from a credit risk perspective does track very well. If you look at any of the publications that have been done around the wallet hierarchy of customers, so looking at, hey, what do customers pay back? The number one thing customers pay back, hell or high water, it might surprise you, with cell phone bills. People will lose their house and lose their car, and they will pay their cell phone bill. The default rates on cell phone bills are infinitesimal. After cell phones, mortgage is typically the obligation customers prioritize second. Auto is third, and once you get out of auto, what you see is a relatively dramatic departure because, again, if you don't pay your home, you lose it. You don't pay your auto, you lose it. But when you look at what gets paid next, what you find is that home improvement loans, and in particular residential solar, tend to rise to the top. Because they rise to the top and they're high on the customer's wallet hierarchy, it's why you see stability on performance above and beyond what you would see for even other home improvement products, things like in-ground pools, room additions, exteriors, roofing, siding, room additions, et cetera, et cetera. So it's a product that despite having a high balance at $45,000 or $50,000, performs pretty well. It's a pretty long duration asset. The terms on residential solar loans can span anywhere from 10 to 25 years. We actually have one client right now, they're going out to 30 years. They're essentially trying to match the duration of the loan with what is expected to be the useful life of the panels. So whenever you amortize a loan over a long period of time, it allows for generally pretty manageable monthly payments. So, again, if you look at, hey, if I'm looking at deploying my balance sheet, what are some of the things that solar brings to the table? It's a longer duration, relatively high quality, relatively lower volatility asset. And it's one that, you can sleep well at night knowing that to the extent that customers aren't paying, you have good recourse. You have the standard recourse, which is going to be, your standard credit reporting, usually around day 45 or day 60. So showing a minor derogatory, they charge off, day 120, 180, you trigger the major derogatory. But in addition to that, the system shutoff dynamic is something that is unique. So we at Goal, we do a lot of system shutoff work for our clients today. Typically what you're doing is you're notifying customers, we recommend notifying them earlier, but typically around day 30 or day 45, we actually have some clients who are at day 15 or day 20 of delinquency. You're sending out those initial notices to customers saying, hey, you're past due, we've tried to get in contact with you, we haven't been successful. If you don't call us back, we're going to be shutting your system off in relatively short order. That will generate inbound calls, at which point in time you can educate customers about, hey, to the extent your solar gets shut off, your utility is just going to turn back on. And if you go back to why you invested in your residential solar system to begin with, it's oftentimes because you felt that it was a better ROI than investing in your utility company. So, it drives some differentiated conversations relative to some of the other consumer products in the market. And so we think it provides, for a relative value perspective, a really interesting product. I would say there's a very diverse set of people who deploy capital into residential solar. As Al mentioned, we do work with, state, regional banks. We do work with national banks. We do a lot of work with credit unions. We do work with, large asset managers. We do large insurance companies have been very large participants in residential solar, in particular the last 5 or 6 years. Like the long duration nature of the assets that match funds very well with their premiums. So solar has been an area that you've seen a lot of liquidity in. That means if you are originating loans into the residential solar space, you oftentimes have multiple avenues for offtake to the extent that you decide to, disposition some of your balance sheet that is solar loans. That can take the form of, shedding participation interest, which is, more common inside the credit union space, selling whole loans directly to other buyers in the market, or tapping the securitization markets. There's typically 10 to 15 billion of residential solar public securitizations done every year, and that doesn't account for the probably another 5 to 6, 7 billion of private rated ABS that's done for residential solar as well. So it's a highly liquid market. So it's not one where if you do originate some solar loans today or you acquire some solar loans today, you're ultimately going to be stuck with them and not necessarily have some way to disposition them. When talking about solar, I'd be remiss to not talk about some of what's going on in the industry right now. So if you Google, hey, what's going on with residential solar, invariably you will learn about the changes that Trump has made. The Trump administration has not been super friendly to residential solar. While that has generated, I would say, some near-term headwinds for the space, I personally think it's something that in the long run is very healthy. There are a lot of people, myself included, who believe, while the 30% investment tax credit that existed previously, so essentially, if you put a $50,000 system on your house, you could apply for a tax credit for 30% of that. While that was, I think, helpful in some ways in making solar more accessible, I also think it drove some behaviors in the industry that were probably not necessarily ideal. It enabled some very high margins on the installer side of the world. It enabled some very high sales commissions. And if you look at some of the public challenges some corners of residential solar have had, it's been around a lot of these dynamics. It's been aggressive sales practices. It's been installers who are maybe chasing sales with a little bit too much vigor. But if you look at what's come out of that, I think it's a really healthy maturation of the industry. A lot of those installers who had created some of the more I'll say challenging headlines and had created some of the what are perceived to be current headwinds. You've seen a lot of them go out of business. There's a rationalization of the sales commissions that are being paid in the space. And so when you look at what's going to come out of residential solar as a result of this, I think it's going to be an industry that is much more mature. It's an industry that's going to be much more rational. It's going to be an industry that generates customer savings on day one and doesn't have these dependencies on this investment tax credit that may or may not ultimately be realized. And it's something that, we as an organization, while you'll hear some people say, hey, solar seems like it's at a little bit of a penalty box from a legislative perspective, it's an area that we're spending a lot of time in. We're leaning into it, both the what's called the third-party operated side, which is where you see leases and power purchase agreements, and on the loan side of the world. And I guess I should probably spend just 1 second on some of the differences between what was called the TPO space, third-party operated space, and the residential loan side of the world. When you put solar on your house, you have two choices. Choice one, you can buy the equipment, typically utilizing a loan, then you own the panels that are on your house. If there's anything wrong with it, typically you're going to work with the manufacturer warranty for your panels, your inverter, et cetera, et cetera. Or you can go what's called the third-party operator route, which are TPO, third-party owned route. In that instance, somebody else, typically a financial buyer or the installers themselves, they own the equipment on your roof. So they put panels on your roof and you acquire power from them, either via a power purchase agreement, which is typically you're paying per month based on the amount of energy you're utilizing, or under a lease, where essentially you're paying a fixed amount per month with some annual escalators, and that covers the estimated power you're going to pull. Both of them, I think, are really good use cases. I don't think there's like a right or a wrong use case. If you talk to somebody about, hey, why do they believe in residential solar loans? The general hypothesis is that, Americans in particular like owning stuff. And if you're going to put something on your roof that generates power, it probably makes sense for you to own it. Someday you're going to pay that loan off, and then you'll essentially have free power, or at least free power for everything that's being generated by the system. On the other side of the world, there are a lot of people who believe in the TPO market, and their, I'd say, general thesis is you're putting a power plant on your house. Do you think you should be the one to own the power plant, or do you think somebody else should own the power plant and handle all the maintenance that's attached to it? Again, I don't think there's necessarily like a right or a wrong answer. I think it's a philosophical decision that homeowners have to make. As an investor, you can enable either of those products. You can partner with the TPO providers to buy the cash flow streams from the leases or the PPAs. On the loan side of the world, you can buy the cash flows, you can own the loans. The choice is really up to you as the investor which ones you want. I think they both speak to the same dynamic, which is investing in a renewable power space that allows consumers to get the benefit of a sustainable, lower cost form of power, oftentimes than pulling from the grid. And so I think as an investor, it's really about, sitting back and thinking about what's the right type of exposure, what do you think makes the most sense for you? But inherently, they're just two different ways of solving the exact same problem. So, I would say that that's a bit about the solar market where it is today. I do think it's a bit of an interesting time because of some of the perceived headwinds you see with the Trump administration and the removal of the investment tax credit. You have seen some changes in the space. It's opened up some opportunities for originators and for lenders. Some of the incumbents have either made strategic decisions to shift away from the space. A lot of them have shifted into home improvement, or they've shifted into some other sections. Or because they weren't necessarily running great businesses, they've had to kind of close the doors. And while that's been unfortunate for them, it has really opened up new opportunities for newer participants in the market. Those newer participants are facilitators for loans. They oftentimes are not holding them on their own balance sheet. So if you were to look at today, we provide services, primarily primary servicing services, so billing, payment processing, and collection services for about 7 active residential solar originators in the market today. Very few of those originators are actively holding those assets on their balance sheet. They are effectively facilitating the origination of the assets, then they are looking for partners to take the financial stake in the assets. Those investors could be warehouse providers and credit facilities. They could be forward flow buyers. Those forward flow buyers take the form these days of primarily asset managers, credit unions, and insurance companies. Or they'll look to the securitization markets, where they will structure up rated bonds, and then any of the financial stakeholders I just mentioned can acquire senior notes in the structure, mezzanine and subordinate notes inside the structure, or equity inside the structure as well. So, I do think the industry is at a bit of a crossroads, and I think that provides some really compelling opportunities for new investors to come into the space, bring some more ingenuity into the products. I think for a long time, the product structure was too overly reliant on the investment tax credit. And so a lot of the products were really kind of oriented around that. If you look at some of the newer products that are coming to market today, they're products that have annual escalators. So they will rise every year, the monthly payment for 5 or 7 years. They're essentially trying to mimic the trajectory of utility payments, which is a lot of what goes on the lease side of the universe. Or we have one client doing something really interesting, which is kind of periodic reamortizations. So you'll have one monthly payment for the first 3 to 4 years, then it will reamortize. You'll have another monthly payment for the next 3 to 4 to 5 years, and that'll carry on through the life of the loan. Again, what you're trying to do there is set a monthly payment today that generates savings over the current utility, and then increase that payment over time, because you know that typically utility payments are rising over time. And so you need to raise the monthly payment on the loan itself, but you're doing it at a rate that in success still keeps that monthly payment on your solar lower than the monthly payment you'd be paying on your utility otherwise. And so, again, I think if you take a big step back and you look at it as a space that, generates real value for customers and attracts a lot of very high quality homeowners, and is seeing a lot of new innovation in the product space, and has what we think are some really favorable macroeconomic trends behind it in the future. We really think that, investors, if you're looking for ways to deploy capital, and given that there's a lot of available liquidity, so that if you do acquire the assets, you're not going to be stuck with them in perpetuity. We think it makes a lot of sense for people to spend time around residential solar, dig in, understand some of the dynamics I'm describing, partner with people who you are philosophically aligned with, who are generating accounts. If you don't want to go out and do the work yourself, we do know that credit unions in particular will go down the, direct customer acquisition route. I do think that's a little bit unique. Most of the investors we see in the space are typically partnering with a point of sale provider. If you look at how residential solar loans are typically sold, it is at point of sale by the the installer, sitting at a kitchen table, talking to a customer about their energy needs. And so if you think about, hey, what's the best way for me to acquire residential solar customers if I'm an investor? It's going to be really hard for you independently to get into the kitchen table of the customers and sell the product. And so what you ultimately want to be doing is partnering with some of those platforms that are integrated with the installers, typically via the point of sale systems the installer used to size and sell systems into the house. And so, finding your way into some of those partnerships is something that I think can be really accretive for a lot of investors. We have a lot of those facilitators as clients. And so to the extent that there's anybody on this call who, thinks, hey, that's an interesting space, I'd like to find a way to get some involvement, I'd say, please don't hesitate to drop me a line. I spend a lot of my life trying to, connect financial institutions looking to deploy balance sheet with some of the facilitators who are doing, really interesting stuff inside the space. And, my offer to anybody here would be, if there's, more I can ever provide insights on about residential solar, or if there are connections that investors want to make into facilitators, please, feel free to drop me a line. I feel it is sort of my duty as an advocate for our clients and an advocate for the broader residential solar space. So with that, I'll pass it off to Al and Matt, who I think are going to talk a little bit more about some of the contractual nuances associated with, some of the enhanced protections you get in residential solar.
Thank you, Matt Myers, and I'll introduce Matt Young again, one of the shareholders in our firm, who's going to discuss some of the documentation related to the transactions that Matt Myers was talking about. I will also remind all the participants that if you have questions, feel free to pose them into the chat, and we'll fit in any questions that are raised and provide some answers as we go along. Other than that, Matt Young, I'll introduce you now.
All right, thank you, Al. Matt Young, as Al said, I serve as corporate counsel for credit unions, largely in Ohio, and have been for 23 or so years. I also represent credit unions outside the state of Ohio, but largely my wheelhouse of clients are here in Ohio. And in terms of solar loans, as an Ohio General Counsel, we see them in three ways. One, through loan participations, direct lending situations where a member comes to the credit union directly and just finances these, and perhaps more commonly through what I will call an indirect arrangement, utilizing a third-party vendor, dealer, if you will, to direct and arrange financing with a credit union. Many of you probably know about loan participations, but I will just briefly go over that concept with you all to the extent there's folks on the call that don't understand that process. And from a high level, credit union loan participations is a collaborative lending process where one credit union, the lead originator, makes a loan to a member and subsequently sells shares of that loan to other financial institutions known as participants. The mechanism allows credit unions to share risk, manage liquidity, just diversify portfolios, and increase earnings. So there's a positive aspect to it. Key aspects of these loan participations include a structure whereby the lead institution originates and services, in most cases, the loan and retains a portion. And that retention portion varies based on whether it's a state or federally chartered financial institution. Federal credit unions must retain 10% of the loan, whereas most states allow a lesser amount at 5%, although that varies somewhat by state, while selling the rest to the participants. Loan types for loan participation can be varied from anything from commercial loans, residential loans, consumer loan pools, and certainly solar loans like we're talking about today. With respect to the relationship in these participations, the borrower usually only interacts with the lead financial institution, in my world, the credit union, which handles all administrative tasks and then passes on pro rata payments minus fees to the participants. As part of this process, the National Credit Union Administration and states require contracts that have very specific terms that must be included in the participation agreements. I'm not going to get into the elements of that now. Just after lunch, I will lose you fast. But suffice it to say, I have reviewed a number of these contracts over the years, and more times than not, many or most of the terms are in these agreements, but sometimes they're missing or not entirely inclusive, and we do want to make sure they are fully compliant. So when entering into agreements of this type, it is my strong suggestion that you get legal counsel to review them so that you're starting the relationship out right. The second type of loan we see, as I mentioned, is the direct loan, and I'm not going to talk too much on that. That's probably the most straightforward. But third is what I characterize as the indirect lending relationship. And in these scenarios, retail sellers, the dealers, if you will, that sell the solar systems to consumers, have third-party agreements with the lending institution, who in turn finance the sale of these solar systems to the consumer. Financial institutions need to be aware that through these arrangements, they are subject to what's known as the holder in due course doctrine, which I'll discuss more in a moment. But essentially, the consumer can raise all claims and defenses he or she has against the retail seller, against the financial institution financing the agreement. And this is notable given the increased regulatory scrutiny we're now seeing that is placed on solar system sales following the rise in its popularity in recent years. So with respect to this regulation, this increased scrutiny, as with anything, with rapid growth comes additional regulatory scrutiny over industry practices, including concern over the potential for consumer harm, consumer abuse. Most recently, the state's attorneys general, to a lesser degree now the CFPB, and other consumer advocacy groups have been critical of issues regarding solar sales, particularly surrounding dealer fees, marketing practices, and misleading communications regarding loan terms and tax credits. When we talk about the dealer fees, the assertion by opponents is that solar lending transactions builds hidden fees into their loans by marking up the principal on those loans, and these dealer fees often increase the loan cost by 30 or more percent above the cash price of the solar loan project. Opponents assert that frequently the financial institution will then bake these fees into the loan's principal without including them in the stated APR, the annual percentage rate, which is supposed to be the clearer cost to the consumer of carrying that credit. And so it's being shaded in that way. The assertion is that lenders are rarely and clearly able to separate these markups from the total cash price that consumers would otherwise pay for a systems installation. So those are some of the fees we see, complaints we see regarding misleading claims, as well as kind of some more straightforward exaggerated savings claims. Consumer reports are supposedly referencing consumer panels typically generate greater savings than they actually do. So if you live in California or if you live in Arizona, these savings might be actually fantastic. But if you're living in our neck of the world here in Ohio, where there's a lot of gray sky, maybe we're not getting the type of performance we might otherwise have expected based on what was represented to us in a sale process. So these are the type of things that cause then consumers to go to attorneys and see what claims, if any, they can make against these selling entities. And that's where the holder in due course rule comes into play, and that financial institutions need to be mindful of. The FTC holder in due course rule protects consumers by ensuring that they claims and defenses that they assert against a third-party creditor, like a bank from which they purchased, are the same as those against the original seller. So the purpose is essentially that the consumer can stop paying for a defective product or service, even if the financial contract has been sold or assigned to a third party or another banking institution. So just something to to be mindful of. We can't, as financial institutions, say simply, we didn't create the product, we're not responsible, pay us. The holder in due course doctrine will prevent that from happening. So as part of contracts where this provision applies, you must include mandatory notice, and many of you might be familiar with what that is. It's typically in the boilerplate provisions on the back of a loan. It says something to the effect of, in all caps bold, any holder of this consumer credit contract is subject to all claims and defenses which the debtor could assert against the seller. So that has to be in those agreements, but that serves as a benefit to the consumer. Now, notably, there's a limitation of recovery provision in this HDC rule, so a consumer's recovery under the rule cannot exceed the total amount he or she has already paid under the contract. So with the holder in due course rule in mind, and in light of the regulatory considerations and implications that result from the HDC rule I just discussed, financial institutions will want to ensure that it has appropriate agreements in place with any solar dealer in which it transacts business, to ensure that it has, of course, among other things, certain standard warranties that you would expect in agreements of this type, but also some more specific language, such as including terms in the third-party agreement that the dealer agrees to use loan documents and applications acceptable and approved by the financial institution, and include language that the financial institution maintains 100% discretion over loan approval. You also want to include terms in the agreement that the dealer provide closing documents and perfect the security interest if applicable, or at a minimum provide the documents to the lender to facilitate that perfection in the collateral in no less than 30 days after the loan closes. Part of that third-party agreement also needs to include the HDC language that I mentioned, and I would cite that verbatim, and I would put that again in all caps in a segregated box as required. And then finally include buyback provisions in the agreement, providing that if any dealer warranty is breached, or if a consumer asserts a buyback claim under the FTC holder rule, that the dealer will buy back the loan for the unpaid amount of the note at the time of the demand. So those are some of the contractual terms we like to see representing the financial institution when entering into some of these indirect deals.
Thank you, Matt.
Sure.
Any questions? Again, as we mentioned, roll them right into the chat, and we'll get to them quickly. My job and Matt Young's job is to be the counterpoint to Matt Meyer's rosy picture about this industry. We're lawyers, and so we're the voices of doom in terms of any transactions like these that you get involved in. But we also wanted to be realistic about this type of lending, as with any program that you lenders get involved in. There's always concerns, number one, with the enforceability, as Matt Young had indicated regarding the transactions, and also my topic, which is the collectability of the obligations. These are loans that are being made that you either originate or purchase or participate in. And so there's always concerns about the ultimate potential for a portion of those obligations to go into default and create loss for your institution. And generally, I agree with Matt Myers. These are loans that perform very well. They're large balances. They produce a nice revenue stream for the lender. The interest rates are strong, in line with other types of consumer lending. You're dealing with a population of borrowers who are generally our homeowners, and so they are more substantial borrowers, and they are where they are expected to be found, because they don't leave the property that they obviously own. And to a large extent, all these obligations are secured. They are either secured with a financing statement as personal property, or they are secured as fixtures to the property with fixture filings, and so they attach to the real estate in that way, creating a security interest that adds to the protection that you as the lender have. Just in general, to go along with some of the things that Matt Myers alluded to, in that industry, about 58%, of almost 2/3 of the loans of the transactions are direct loans that are created between the sellers and the buyers. The loans are then sold, transferred to financial institutions of one kind or another. About 20% of transactions in this space are cash transactions. And as Matt Myers had mentioned, about 23% of the transactions essentially are leases, where the homeowner does not own the equipment, but does gain some benefit from the equipment being installed on the property. Again, just some other statistics. By far, the huge majority, twice as many of these transactions occur in California that occur in any other state. The other large states that participate in this type of lending are Texas, Florida, Arizona, and New York. No surprise with any of those. But it does point out the fact that a huge percentage of the transactions that occur in solar panel lending are concentrated in a few geographic areas. And so that does, and I think it should, create at least some pause in terms of the realization that you are concentrating a large percentage of those type of loans in a small geographic area. And therefore, the portfolio itself might be subject to economic swings in a particular state or a particular jurisdiction, and that may be something that you need to be concerned about, as opposed to other types of lending that obviously would be spread more evenly across the country. So there's some risk involved in that concentration, but not significant. Just from the numbers again, as Matt Myers alluded to, in 2018, volume was about $1.2 billion in this space. 2023 was up to $12 billion. So obviously it's a solid product, and it's a growing product. And as Matt Myers indicated, even with or without interference, if you will, by the feds, it's a product that the consumers want, need, and are willing to pay for, especially when you take into account the fact that it's the type of a product where the consumer can actually realize revenue stream in the form of electricity selling back to the grid, as opposed to a typical loan where they're not acquiring or realizing any profit from that effort. When you look at this type of lending as a function of your desire to reduce or eliminate or control loss, at the beginning, in the early 2020s, there was virtually no loss to be suffered in this space. So virtually no delinquency, virtually no loss. Even in 2021, you're talking about a delinquency rate of 90 days and above of less than 1% actually at that point. And when you compare that to mortgage loan delinquencies at 0.5%, auto loans running at 3.73%, credit card loans at over 6%. Even in 2025, solar loans were running 90 days or more delinquent at only 0.9%. Therefore, not a lot of risk, even though there is a shift in terms of the level of delinquency. which I think is indicative of consumer borrowing in general over the past few years, where there's been some additional interest pressures and pressures on the consumer, which have resulted in generally higher delinquency rates across the board in all types of loan products. One of the surprising things about this type of lending, because it's sold to you, the lender, as secured loans, and so the fact that there's security for the loans to your decision making, it automatically indicates a safer product. But there's a problem with it because of the fact that when you make these type of loans, the security, the collateral for the loan is the equipment, is the solar panel equipment. And in one fashion or another, as we'll see in a couple of minutes, there is a lien that you hold on that equipment as it's sold and installed. And by definition, that means that if the loan falls into default, you have a right to recover that equipment in one fashion or another. The problem is that the value of this equipment after it's installed, and if you attempt to recover it, is very low. And there is one statistic I saw that indicated that out of the total loan amount or total balance amount that's you're attempting to recover, the recoverable equipment value is only 10 to 15% of that balance overall. And when you factor in the removal cost and the legal cost involved in recovering the equipment, your net recovery on those loans that you thought was secured is zero. And so you have to take into account the fact that used solar panels, after they are removed from real estate, does not have a very significant value. So how do you maximize your recovery if and when a loan that is secured by solar panels goes into default? The first issue, the first burden that you have to make sure that you satisfy is the fact that you have to record that security interest. So if you do not record a financing statement or a fixture filing UCC statement to perfect your lien on the equipment, you will be unsecured. And so that's one of the things that we see when a lender attempts to enforce the contract and recover its equipment, is that they may have failed to properly file a financing statement, or they have filed it in the wrong place, or they have filed it in the wrong form, or they have failed to follow a state statute in order to perfect that lien. And so it's critical that number one, your process includes the verification that a lien has been recorded, and secondly, that it's been recorded properly. The next issue to be concerned with is whether or not this particular equipment is personal property or whether it's a fixture on the real estate, which requires two different kinds of perfection. I'm going to stop here for a second because a question came in. In general, notwithstanding state laws, are senior liens required to notify us of their foreclosure action when we have UCC filed against the equipment, solar panel inverters? That's a good question, and it's essentially the question that I just started discussing, and that is whether or not the solar panels have become a fixture on the real estate, to have become part of the real estate, or whether the panels are personal property and can be removed from the real estate and therefore they are not fixtures. So if the panels have or are defined by that state or by a court to indicate that the panels have become fixtures on the real estate, the answer to your question is yes. A foreclosing mortgage holder would have to name you as a lien holder to the extent that the fixtures are attached to that real estate. If the property is personal property, then the answer is no. If the property can be removed, it's not part of the real estate, then it's simply subject to the perfected lien in the form of a financing statement for personal property and not included in a foreclosure at that point. But again, you're dealing with different states, you're dealing with state law, you're dealing with local jurisdictions in terms of how judges look at the solar panels as they exist and attached to real estate to determine whether or not that property has become affixed to the real estate and now is a fixture. A significant problem that we have encountered recently in representing lenders and dealing with defaulted loans secured by solar panels is the situation where the borrower, owner of the real estate, sells the real estate. And now there's a new owner of the real estate with these panels attached to it. And the previous owner has kind of washed his or her hands of the problem, walked away from the loan because they sold the house that the panels are on. And the new owner, of course, doesn't want to have to pay for the solar panels that are now affixed to the property. And so we run into some significant problems in terms of taking actions to recover that equipment from property that has now been transferred to a third party. And we have some very practical issues when you're dealing with that particular problem because of the fact that you are pursuing someone who is not your customer. You don't know this individual who now owns the house. You don't know, you may not know who they are. You definitely don't have the demographics about the individual that you need to properly pursue action against that individual. For example, you don't know his or her social security number. And so you don't know the basics of who this individual or individuals are that would allow you to effectively pursue recovery of your collateral. And so there's some very practical issues that come up in the context of real estate that's been sold and is now in the hands of a third party in terms of attempting to recover the collateral, number one, and number two, pursuing the original signer if the original signer is still available. And as I said, the other issue in terms of your effort to recover is that issue of whether or not the solar panels can even be removed. And so if there's a determination that the solar panels are now fixtures, now you have to deal with an action against the real estate itself to get your portion of the proceeds to get paid. Or if you determine that the solar panels are personal property and subject to a financing statement, then of course you can pursue the recovery of the panels in that fashion. So excuse me. So from a collection standpoint, we are seeing that there are rising default rates in solar portfolios. There are higher losses being suffered than early in the evolution of this particular product, and there's a recognition in the industry that you have to be very careful with the sellers and the installers that you're dealing with, so that you, as Matt Young had voiced, so that you're not stuck with defenses being raised against you, the lender, which are really the fault of the installer or defective seller of the goods. Those are the largest area of litigation that goes on in this industry is really sales misrepresentations, as Matt Young had mentioned, inflated dealer fees, incorrect determination in terms of the viability of the borrower, and just in general the heightened regulatory scrutiny of these types of loans, whether it's from a local standpoint or the standpoint of the federal government. So any other questions that we have?
Yeah, I think Al has a question there about kind of reliability of solar products. You know, what I would say on reliability of solar products is typically the installers are not the manufacturers. So when you look at, you know, what are the quality of the underlying goods, I would say most reputable installers are using, you know, inverters from a company called Enphase, which is very large, very well known, has a great reputation. You know, panels made by a company named Maxion, or Q Cells is another large panel manufacturer. So I think in general, if you are dealing with an installer that is using some of the larger manufacturers of the equipment, you should feel pretty good about what's being installed. So like I can give a personal example. On my house, I have a system that was installed by a company named SunPower. SunPower was one of the largest vertically integrated solar installers and financing providers in the country. SunPower went bankrupt about a year and a half ago, so completely insolvent. But the equipment that SunPower installed, even though it was SunPower branded equipment, was really Enphase inverters and Maxion panels. And when SunPower went bankrupt, I got correspondence from the underlying manufacturers that said, hey, we understand your installer's got insolvent. Just know all your manufacturer warranties are still intact today. Your panels and your inverter are registered. If you have any issues, you know, please, you know, feel free to give us a call. So I would look at larger, more mainstream residential solar installers as generally putting high quality equipment into people's houses. SunPower, the company I just referenced, their portfolio of loans and leases, which we actually service ourselves, is the best performing solar portfolio in the market right now. And that is despite the fact that the company has been entirely insolvent for the last, you know, call it like 18 months or so. And so I think that's something that's really critically important. Solar at the end of the day is point of sale. And so whether you're talking about home improvement, residential solar, elective medical, the whole universe of financing that is sold at the point you are acquiring the products, the repayment performance is oftentimes only as good as the underlying product. If people are dissatisfied with what they bought, they are not going to pay back the underlying loan. Whether they can or should, you know, they have legal obligations, kind of a longer conversation. But I would say dissatisfied customers are not paying customers, and satisfied customers, kind of all else equal, are paying customers. So it just gets back to the diligence that is required around the installers you're working with, you know, how, you know, making sure that you can vet the work they're doing, reviewing their complaint histories, you know, making sure you understand what is the reputation of that company in the market. So that would be sort of my 2 cents on, like, you know, generally speaking, what is the quality of what is being installed, and then what kind of work should you up front to verify that, or at least verify the complaint history of the installer, because that will, you know, lead you down a happy path or potentially a not so happy path. And then Matt Young, I think there's a question here about HDC that's probably good for you.
Yeah.
Let's see here.
If the
I have my answer, but you are an expert on this. So
Yeah, no, go ahead. We're processing this. Go ahead.
Yeah, so this gets to if the holder in due course applies to some of the other provisions around, you know, warranties around the equipment and et cetera, et cetera. From what we have seen in the space, the financial obligation has been oftentimes separated from some of the more manufacturer-specific warranty claims in the contract. Now, it does vary depending on how that language is stated, at least from what we've seen. But what we have seen a healthy amount of is the financial obligation piece surviving and being subject to HDC. Some of the other stuff around manufacturer warranties, performance guarantees, and things like that left behind. But from what we've had to experience, it's been very specific to underlying contracts and the language that goes into them, which I think, to your point earlier, is why understanding the language around these types of things matters so much.
Right. That's right. So, I mean, where you have these, you definitely want to look into the third-party agreement that you have, because we might have to assert additional claims against parties, and that's going to be potentially fact-driven. So having the indemnity language, et cetera, in there, we would assess fact pattern and the terms in the note, and then apportion responsibility that way.
And just the fact that the original seller is out of business doesn't automatically create claims under holder in due course. So there has to be some valid claim that existed prior to that incident in order for the consumer to pursue the lender. So there's always limitation in terms of who the consumer can pursue.
Yeah, because I would say we see less claims about, hey, the system is junk and never worked, and more claims about, hey, the salesperson said I was never going to have a utility bill ever again, and now I have a utility bill for $20. I mean, I would say it's more lands in sort of the gray area that, I think both, Al and Matt alluded to, of sort of salesperson misrepresentation. It's not always as black and white as like, hey, I paid for a system, it never got permission to operate, and like this thing is a piece of junk. It tends to be a little bit more nuanced, at least for most of the cases that we run into.
Right.
Okay, I don't see any other questions unless I'm missing something. So we Matt Myers and Matt Young and I'll appreciate you participating today, and we'll wish you a good afternoon. Thank you.
Cool. Thanks, everybody.
All right, take care, everybody.